to hand over to Carlo. He's going to take us out of the campsite, hopefully, and into thinking about managing our cash flow. Thanks, Carlo.
Thanks for the intro. Look, the first of the four lenses that we want to talk to tonight is about managing cash flow. Effectively, this is all about understanding and rigorous management of the cash that moves into and out of your business. The first step is relatively intuitive. As Annie mentioned, this is really about taking stock. For many businesses, this has largely been done in some manner or form since the emergence of COVID-19, but can really be done at any point in time. This is about having or taking a simple and quick review of the financial statements of accounts and understanding what's still to come. For many smaller businesses and sole traders, which we know within the Darebin constituency is quite a high number. This also brings on the added complexity or the blurred lines of personal and business finances. So at this stage, it's also good to look at how your customers' purchasing patterns have changed. Are they buying less of everything, less of some things, or possibly more of some? What are the major changes in cash inflows? Well, what were the major cash inflows before COVID-19, and what forms the largest share today? Fundamentally, this first stage of cash flow management is about understanding how your business inflows have changed. From there, we map your expenses. The most important costs to look at here are any recurrent costs like rental for premises, wages, insurance, mortgage repayments if applicable. Not only are these likely to be quite large expenses as a percentage of the overall costs, but they are often independent of sales, so they don't naturally drop with when business performance slows. Again, if you're a sole trader, you'll have the added complexity or added layer of personal expenses to think about, and the ramifications of that on on your broader wage and life. But based on these existing expenses, and based on what you understand to be the current inflows, how long can you survive with little or no revenue? This is what we call the basic understanding of a runway. What is your runway? The next question that informs your cash flows is how long you think the problem's going to last. This is going to be different for every business and it's going to be dependent on size, complexity, industry, the opportunities that present. As Annie mentioned, for TDI, for example, we have about 50% of our work that spans across the South Pacific is largely on hold due to flight restrictions, and that's likely to extend probably at least into Q1 or Q2 of next year, if not longer. The work that we have cross-border, domestically, in terms of Sydney, Darwin, etc., that can't be done remotely, we expect there to be further disruptions for this for another few months. It's going to be interesting to see how the latest windback affects this disruption, and obviously state-based work and those projects that can be done virtually, like tonight, we expect there to be a lot less impact. But in this way, it's really important to understand how different products and services for your business might be impacted independently of what's happening around you. The next piece is to understand what liabilities or accounts receivable are outstanding. If you have any money outstanding, this is a really great time to chase it down. Recovery rates for accounts receivable diminish exponentially over time, with most businesses only recovering about 15 to 20% of total accounts receivable in the greater than 90 days category. So absolutely imperative that you start chasing down any monies outstanding if you haven't done so already. The second piece then is around accounts owed. And for any accounts that are owed, there's an opportunity to do the opposite, to try and negotiate terms. We know that this crisis is hitting people differently, hitting businesses differently, and so there's different requirements for different businesses. It's always worthwhile asking the question. So the important piece here really in terms of cash flow management or in terms of these 5 questions is really around being vigilant about cash. The old adage, that cash is king, is truer than ever. And it might be useful also, Annie, if you wanted to share some reflections on our own journey at TDI, particularly the piece around new modelling tools.
Sure. So I'll just something I forgot to mention at the start is question and answers. We will have a Q&A time at the end, but if people do want to post in the meeting chat, which you can do there's a little toolbar. If you go along there, there's a conversation piece, and you can just type in there if you want to type questions as we go, and we'll try to answer questions as we move along. Sorry, I was meant to mention that at the beginning. This was, and actually with all the businesses, not just for TDI, with all the businesses we've worked with, this has been one of the starting places. And there's been a lot of groups that have come to us and said, oh, we want to pivot, we want to create new product. And we've really pushed to go, do you have a survival plan in place? And do you know when you're going to run out of cash? It was interesting because when we first started talking about this, everyone was talking, oh, we'll be in lockdown for like maybe 3 or 6 or 8 weeks. And then the economy will just snap back. I don't think anybody understood at the beginning what was going to play out. And even for us, I know our board said, can we get a 3-month plan? And I said, we should be writing a survival plan that takes us through to December, or understand how we're going to survive through to December, and work back from there. And, it was interesting because all of our traditional forecasting tools for us were loaded with assumptions that didn't work. And so we went back to really basic. How much cash have we got? How much cash are we owed? What are our expenses, or what are our monthly outflows? And how long do we think this crisis will last for, or the restraint on income will last for? And then and Carla will talk about some other questions that we went to beyond that. But it was, I think, for us, and actually for others that we've worked with, we found a lot of their traditional tools, or whether they were spreadsheets or whatever that they used to forecast out, just were loaded with assumptions that we've ended up like throwing out and creating some very simple, how much cash, what's coming, what are you owed, and what are you likely to be able to retain over this time? And I won't steal your thunder on the next question, Carlo. So that's survival plans. If you haven't put that in place, I'm hoping that you have. It's really important because it does give you, it helps you with your risk appetite too. If you need to purchase at this time, the impact that will have on your business and what you're doing. Back to you, Carlo.
Thanks, Annie. Yeah, to build on what Annie said, I mean, the core piece in terms of cash flow is a fundamental piece in terms of any of the financials, or I guess the financial conversations, or the other 3 lenses that follow as well. So this is a core piece that we know that a lot of businesses have spent quite a lot of time understanding and analysing their financials to date. But it's really a bit of a refresher, or a pointer in terms of some other areas to focus on as well. The second lens that we're going to look at this evening is then around reducing costs. So during this time, more than ever, there's an opportunity to frequently review your operational expenditure to ensure that it's as efficient as possible. We usually say that a good place to start is your incidentals and miscellaneous spending. For most businesses, this ranges or accounts for approximately 1.5% to 5% of your overall expenses. So the rule is if it's not urgent and it's not going to interrupt normal operations, try to find a way not to spend it. So for us, things like professional development, which would usually be on the cards, even budgeted technological upgrades were the first things to go for us. So any operational expenses that don't need to be spent right now in terms of being able to free up cash effectively. The second piece is then around staff efficiencies. So before we have conversations around head cutting or reduction of hours, let's make sure that the staff are operating as efficiently as possible. We know that for most businesses, one of the largest expenses is wages. So look at staff utilisation first, or any metrics that can help you to gauge the efficiency of your staff. Simple things like adding rigour around of more regular check-in meetings can have a significant impact not only on the monitoring and managing of outcomes throughout the week and months, but can also improve engagement within this state of isolation. For several businesses, particularly those with rosters, roster profitability is another critical area to explore. This is really about having the right staff working on the right hours so that there's no wastage in valuable resources during the quiet times of the day. So it's really understanding, I guess, the seasonality or the cyclical nature of the work, and understanding whether there's an opportunity for your business to be able to roster up and roster down based on when you do and when you don't need people. And it's really another form of ensuring that you are efficiently leveraging the workforce that you have available to you. Obviously, this doesn't relate to all businesses. For us as a service-driven business, that doesn't really relate so much. But those where it does can be significantly impacted through the efficient resource management of personnel. Asking staff to go on annual leave. I mean, this is an amazing time to encourage staff to take holidays. Not that necessarily it's the right time to go away on holidays, but the idea of a staycation or people having a break is potentially incredibly good for not only mental health, but also good for the bank balance. It reduces not only the company liability, but it's also in this time of downturn, it's much less likely to impact business continuity. In terms of capital equipment, you can also look at ways of dealing with your equipment that may reduce the outlay and also create cash flow. For instance, you might think of selling equipment and then leasing it back. You might look at different models like subscription rather than paying for capital in one lump sum. So that said, at the moment, there's also an instant asset write-offs and accelerated depreciation scheme for large asset purchases through the government stimulus package. So it might be worthwhile having a chat to your accountant about an approach there if you think there's a significant investment that you intend to make in the foreseeable future. But where possible, the idea would be looking at innovative ways to, again, being able to free up cash flow through avoiding taking on or paying for large capital outlays. The next piece is relatively simple. Where possible, talk to suppliers to see if you can get a better deal. If not, try and shop around. It's always a great time, now more than ever. Revisit
and on that one, and yeah. Can I just say on that one, don't just keep pushing. If you think it's fair what you're asking for, just keep pushing until you get where you need to get. We've had one supplier that we felt like it was fair what we were asking for because their service was reduced to us, and we've just pushed and pushed and pushed until we've got what we've ended up meeting in the middle. But don't let everybody's in a challenging time. But yeah, don't just take no for an answer, I suppose, is what I'm saying. Particularly if you feel like what you're asking for is fair and reasonable, because some businesses aren't able to supply what they traditionally have been able to supply. So it's meeting that middle line around what's fair and reasonable and not taking no for an answer.
Great point. Similarly, look at your rental requirements in light of the current workforce needs and also the future need. Annie spoke to this concept of the new normal. I think that we firmly believe that there's going to be a new mode of operation. What does that look like for your business? What might the next version, the 2.0, look like for your organisation? Is there any opportunity to seek out new opportunities for rental when vacancies are higher? For some businesses, that's not possible. Many businesses have also been offering staff part-time options as a way of cutting costs rather than cutting jobs. So cutting work time by only 1 or 2 days a week can create a really large saving to the bottom line, especially in service businesses. It's also a really strong signal to the workforce and helps to maintain employee morale. It not only ensures that the IP and content specialists remain in the organisation, and you can also use things like job sharing to ensure operational continuity is maintained, as well as reducing costs. The last piece is then around asset reduction. Are there any assets that you don't need? Assuming that you're going to emerge from the other side, I think it's the right way to think about any business. Assuming that you'll emerge, what do you want to keep? What will you need? What will be costly to rebuy? And what won't you miss? If there's any assets that you think that you're not going to miss or doesn't pass those fundamental, 4 questions: what do you want to keep? What do you need? What will be costly to rebuy? And what will you not miss? Then now might actually be the time to be able to free up some additional cash by selling major assets. Annie, do you have anything that you want to add at this point?
Yeah, I just think you made a really good point there, Carlo, about the question of how do you want to emerge from this? And I think with any of these cost reduction pieces, that's a really important question to ask. It's also really important with anyone who's thinking about borrowing cash as well, borrowing money as well, to survive, because what happens on the other side once we do get back? Have we sold all our assets and got rid of all of our IP? And what are we left with? And so whatever decisions you're making, I think you raise that. I think it's a really good question to be asking, is how do I want to emerge out of this? And this speaks into our survival plan. I said earlier that we wrote a survival plan that went through to December that started with cash and our contracts and what we could renegotiate. It then went to the other side of the ledger, which is where could we cut costs? And these were all the questions that we went through and asked. But that question around how do we want to emerge, whether it's 3, 6, 12, 9, 12 months, how long is the problem going to be there with us for? And the problem is being pushed out. I mean, economists are telling us we're going to be here for 18 odd months. Look, some level of trading is obviously returning currently, and that will get better. But we've got an economy that's had an earthquake go through it, and there's some really challenging times. So that this piece around where can we reduce costs is really significant. Yeah. It's really hard. It's really hard too. Yeah.
Yeah, I think just one more point about that as well. The point up front in terms of the rule of if it's not urgent and won't interrupt normal operations, don't spend it. It's not about being ruthless to cost, and it's not about being non-discriminative, with costs. It's really about being quite surgical, and I think that just sort of adds or extends the point that Annie was making about where you want to emerge. There will be some things that absolutely you should be spending money on. There'll be some types of marketing and promotion which will add significant value during this time. There'll be others that just won't. So it's really important to understand which things you're looking at which costs you can and should cut first. The next lens that we want to talk about is this idea of extending runway. So this is really about once you understand what your current financial position is, how do I extend the length? If we created a projection that we can continue to operate between now and December till March, how are we going to extend that further? The first first things first, know your numbers, basically. In this instance, it's what's your runway. How many months you can cover your monthly, like how many months you can cover your monthly costs, pay any liabilities that you have, any creditors, GST, income in advance, etc. What does your cash flow position look like? How much and how much and where specifically have the numbers been affected? We covered off quite a lot of that up in the cash flow piece, but incredibly important as a starting piece for the emergence or for extension. Know where your sales are coming from. Had they all shrunk by the same amount, or have some shrunk more than others? This may signify where customers are needing more support from you or where there might be a new opportunity to play. This is also a good time to draw on other data sources you might have at your fingertips to get a snapshot at the current state and opportunities. So that could be market data for your particular sector, that could be industry data, that could be, there's a range of different data sets that are available to you, both specific and also more broadly. Also, how to look at your asset. Sorry, go.
Sorry, Carlo, just on the data point, we were talking about this earlier, you and I. Yeah. Something I found really interesting is our the group we bank with have been running, I think they've run 3 now, webinars with their economists and the head of their business banking. And they've been quite generous in what trend in those webinars. I've sat through all 3 of them in what trends they're seeing, what they're seeing happen in market. And so accessing those types of forums are really very interesting. Plus, if you have a business banker, they have unbelievable data with what's going on and who's buying what and what sectors are down, and even understanding is what, you know, we've spoken to lots of people in doing the same sort of work as us to understand, is what we're experiencing what everyone else is experiencing, or is our experience different, and if so, why? Carlo and I were just having a conversation today about another consulting group who do similar work to us and who he'd been in contact with, and it's positioning yourself to understand, am I on par and everyone's really struggling, or are people finding other ways that are creative ways that I could tap into? What data exists? And I'm not sure whether, Stephanie, council has data that could be available to local business about what's happening locally. I'm sure they do.
Yeah, there's a lot of information out there from state and federal government around industries, and I'd be happy to share with our attendees as well. I'll put some links in emails when I also send through the slides to them as well, just to give that bit of understanding for them around the industries, and yeah, would be really helpful. So yeah, I'll pop that in the email to all of you attending today, and we can put that on the website as well too.
All right, thanks Stephanie.
The last piece here is look at your assets. So look at your financial assets, your physical assets, your IP. What are your strengths? Not necessarily what have you been doing, but also what you could be doing. So just a fundamental question around, what are you good at doing based on your assets? Now is really the time to get to know your customers. What are they feeling? What are they seeing? What are they worried about? What can you learn? What additional support might they need? And what will they need next? By getting closer to your customers, not only is this an opportunity to learn valuable insights about how you can help your business, but it also means that you're incredibly well placed to maintain them as a customer post-recovery. There's also a piece around, are there any new customers out there that you could use, that could use your help? For instance, is what you do more broadly applicable than to just those customers that you've been selling to? The next piece is around revenue streams that potentially are lacking or poor performing. Salvaging existing revenue streams may be much, much cheaper and less expensive than building new ones or pivoting. Is there any potential to breathe life into an existing product or service, to promote it differently, or to find a new set of customers for it? The next one is around partnerships. So partnerships can be an effective and efficient way of leveraging combined resources to deliver a service or a product or an outcome. Think about the useful ways you might be able to use your resources and a partner's. Could you pool resources or partners with others to deliver a stronger proposition? The next one, we're going to go in more detail next week in another presentation or another webinar series called Pivoting. But this one really is around, can you deploy your resources, or what, in terms of assets, people, physical assets, IP, etc., into something that's timely and valuable? Do you have an immediate market, something immediate that the market might need? Like, what is your hand sanitizer? If you have one, look to test it in market quickly and cheaply, and analyse the sales data that you get in return. There's some great examples from Darebin, Dexter's in Thornbury, and many other restaurants have reopened as delis, selling food-based essentials. There's various Pilates, dance PT, now being delivered via web linked. Craftco, Neighbours, they're a distillery. They're producing hand sanitizer. Flowers Vazette, again, another neighbour of Darebin. They're a florist that's actually shifted to delivering veggie boxes rather than flowers. There's Estelle, which is up the road from me in Northcote, and other high-end restaurants are now producing deliver home meals. And I was having a chat with Annie today, and Tupperware have now moved to, with their move online, they've grown sales by 400%. So long-term trusted brand, worked out how to do online parties, now taking advantage of the current at-home situation. So they're just a range of different opportunities of products and services, but we'll go into a lot more detail next week. The next one is to look at different channels you can leverage. So can we use online channels to serve our customers? Could you sell through a partner organisation? Could you access new platforms for promotion? At TDI, we've quickly adapted, like Annie said, to the ISO world, and we're continuing to conduct business like many online. So for us, this means relationship management, strategy, accelerators, all types of work that we do, being able to deliver it on work. Now, this doesn't mean that all of the work can be conducted in exactly the same way online. We've had to adapt the design, the length, and the activities of different sessions to suit project outcomes and the new format. For instance, we would usually run full-day workshops. We're now running most of those full-day workshops, or finding that three lots of 2-hour sessions tend to be much more productive online, and also helps to maintain sort of a healthy level of energy rather than a full day of online training. So looking at new channels, how can you be adaptive? You may need to change or think about new modes of delivery through those, or connect it, or alternatively using them as ways to connect to different customers. The next piece is around short-term financial support that's available for access. There's a range of grants and support opportunities around through councils, state governments, and other association grants, also the stimulus package. We would recommend that you search broadly, and also sector specific. So if you're in the arts industry, look both within the sector specific grants and support services that are available, and then also look more broadly. And finally, there's a question around the types of products and services that you're offering. So this is a question around best use of time. Based on your analysis of your products and services, in addition to your understanding of your customer, what is the correct product mix to bring to the market currently? If you can save some time, you can save some energy, you can save resources without losing revenue, look at rationalising your product service offering. Annie, did you have anything else to add?
No, I think the two questions ultimately are, what assets, IP do you have that could potentially be redeployed if you're in trouble, and how quickly can you do that? And you've named that, you know, there's lots and lots of businesses that have done this. Look, we're asking people to do it under such incredible pressure, but there's lots of businesses that have done it really, really quickly. And I think there's lots and lots of goodwill out there at the moment. I know I was telling Carlo, I had dinner with some girlfriends, and I've always banged on about shop local, guys, shop local. And for the first time in a long time, they wanted to talk about, how do we shop local? How do we do that? What does that look like? How do I make sure that the milk that I buy is a local, not only locally produced, but locally owned? And how do I, and I think it's all of those, the level of consciousness around local shopping from the consumer is in a really good place of goodwill. And how do we, as businesses, take advantage of that, but actually deliver what they're asking for? And there's some beautiful examples of people who would have gone out of business, who pivoted to, so they've stayed in their spot. You know, I think okay, so it's not flowers, but it's veggie boxes now. Or okay, we've always done coffee. You can't come in and sit down and drink that, but we can deliver, or you can still do takeaway. And I think it just takes some creative thinking around how do we make that happen. But I always think about, what assets and IP do you have? What do you know how to do? And how can you redeploy that if you're in trouble? There was one funny story, a tourism business, which is, they're in real trouble. I describe them as like the front line of, if we're at war, they're right at the front line of things. Tourism business in PNG that we were working with. And we asked this question, what do you know? She said, and what do you own? She said, I've got a truck and I know alcohol delivery. And so we, in an afternoon or an hour or so, we helped her design what an alcohol delivery business could look like. She's now delivering alcohol to people in isolation. And so it's that piece around, what do you know? If you're in real trouble, what do you know? What are your assets? What do you have that could be deployed differently?
Thanks,
Back
Annie.
to you, Carlo. Thanks.
The last piece is around pricing, and there's a range of different pricing strategies, but we're going to touch on three tonight. One being cost-based pricing, which is very common. One being competition-based pricing, another one being value-based pricing. Cost-based pricing effectively focuses on connecting price with cost of product, or the cost of producing your product or service. So that's basically your cost of goods sold. A cost plus strategy is effectively marking up your pricing as a strategy. And it's a simple pricing method where you add a fixed percentage on top of the production cost of one unit of product. So it's incredibly common in retail. And anybody who's worked in a retail environment will no doubt understand the intuition behind this. But the example that's up here is for a pair of jeans. For instance, we have material cost of $10, labour costs at $30, overheads $15. So the total costs, or summing up the cost of goods sold, amounts to $55. If we want to apply a markup of 1.5 times or 150%, we multiply by that figure, and we achieve a selling price of 82.5. That assumes that we have an understanding of the fact that the additional percentage is enough to pay for additional pieces like wages, any other expenses that exist in the business, that doesn't fall into a per unit cost, so part of the cost of goods sold. So this is a really common pricing method. It's really easy to use and provides a consistent rate of return, which is part of the beauty of this particular pricing mechanism. The downside, like I said, is that it's actually quite easy to set prices that are too high. You're being it's hard to gain intuition out of what somebody's prepared to pay, but rather you're putting a markup on, and what is the rationale behind the markup that you're instituting. The second piece is that the markup could be too low, and may not actually cover all of the other costs that you have in the business other than your COGS. The second piece is then around competition-based pricing. So competition-based pricing is also known as competitor-based pricing, is genuinely used where the point of differentiation between products is quite low, or you're quite similar to the products and services that your competitors are providing. So businesses have 3 options for this type of pricing. They might price below competitors. So usually they'll articulate value for money. An example for this is a home brand cereal. It's owned by the supermarket. They own an absolute ton of data that comes through that through the supermarket as an institution, so they can analyse this information of the alternative stock and competitors, and supply a product that captures those customers looking for the lowest price, effectively. You could price match. For instance, a petrol station. So effectively, you look up the street, you see what your neighbour's doing, and you basically offer a pretty similar thing. There's very little point of differentiation you can see in that example. And then the final one is really around price above competitors. So in this case, you might seek to point out superior quality or value that they're paying for. So a perfect example is of a mobile phone brand, for instance, or a laptop brand, which may argue that it sets themselves apart because they compete on offering a premium product with sleek design and an intuitive operating system. The upsides to CVP are that it's a simple pricing strategy, and the prices are dynamic, meaning that they flow in line with market. They flow in line with what your competitors' prices are doing. The disadvantage is that it takes effort to continuously change prices, which can often lead to complacency, and you may not actually do that. And it's also harder to implement for small retailers, where cutting prices independently of cost as an indicator can significantly impact the bottom line, and you may actually cut too low. And then the final one is value-based pricing. So value-based pricing is a pricing strategy used by businesses to charge products and services at a rate that they believe their customers are willing to pay. So this is all around willingness to pay, as opposed to calculating production cost and applying a standard markup. The business gauges the perceived value that the customer is prepared to pay for an item and charges accordingly. So how does this actually come to life? Effectively, you first need to understand your customers, which comes back to a previous point that we were stating around this is a great time to get to know your customers if you're looking at instituting this type of pricing. The price point is exclusively based on what your customers are willing to pay. So you'll need to confidently know what that price point is. Then it's about analysing the total addressable market. So to reach an accurate price point for acquiring new customers, conduct your own market research. And this doesn't mean going through a company, but it means reaching out to market and interviewing customers, interviewing existing customers to understand the total addressable market and understand how everyone you're attempting to sell values your product, not just the ones who are currently paying for your product. And then the second part is then understanding or continuing to conduct competitive analysis. So this piece really looks to ensuring that you continue to understand the value proposition that you offer or the value that you provide and the point of differentiation, which will give you the final insight into how you're going to base your price. Because we understand that that value-based pricing is really based on somebody's willingness to pay. It's not only based on what your current customers are willing to pay, who know of you and your service, what new customers might know of you through the acquisition stage, but it's also what are your competitors doing, and also what are the points of differentiation. This helps all three things help to understand what the pricing mechanism might look like, or what the strategy might look like. Helps to create some intuition. The advantages of VBP are that it can allow you to capture the full value of the product based on customer willingness to pay, and can be particularly useful in entering new markets as well. However, if you're a commodity or you have product which is very similar to others, this is unlikely to work, because intuitively this is based on a customer's willingness to pay. And if you have some sort of a demonstration that you have a compelling value proposition, it's very difficult to set prices based on anything other than where the competitor sits. Annie, did you have any other points that you wanted to make in terms of pricing?
No, and I do want to leave time for Q&A and make sure we finish on the time that we said. So